Now we're going to take a look at pricing, at profit, and donations. People may wonder what pricing, which is the thing you think of with retail or a corporation, a business, what does pricing have to do with the finances of a nonprofit? Well, a lot, because you are setting prices for your services. And whether this service is paid for by members of the public, by government, by donations, etc., you have to set a price. Of course, you set prices if you sell tickets, if you sell memberships, if you sell merchandise, etc. When you respond to a request from a proposal, an RFP, from either the government, a private donor, from foundations, from corporations, etc., knowing the cost of your service is an essential component to how you respond. Now, many government RFPs will have already set a price. Other RFPs will have a total amount available in the grant, and you have to decide how many units of service, i.e., numbers of children in your after-school program, how many units of service you can provide for the amount available. You have to calculate the true cost of your total service and the true cost of each unit of service. An important factor in this is to understand your break-even point. And that's a very simple formula that answers the questions: how many participants do you need to have at what cost per participant to cover your total costs? Or how many items must be sold to cover your costs? Or how many memberships must be sold? You begin by calculating what's called the contribution per paying participant. And that is the revenue per participant, what you expect each participant to pay for the program, minus the variable costs, how much each participant will cost you to participate in the program. And the remainder is called the contribution per participant. What each participant will pay minus what each participant will cost remains the contribution per participant. Next, you calculate your total fixed costs. And these are the costs that are going to exist in this program regardless of how many people participate. They will always be there, and they're the same. And you divide your total fixed costs, step 2, by the total contribution per participant. And that will give you your break-even point. Fixed cost divided by contribution per participant is the number of people you have to have in this program just to break even. So let's say you wanted to offer a one-day workshop on job searching in your program, a new one-day program, and you plan to charge each participant $50. Let's say you are going to offer them each a free book, but that costs you $20 each, and you're going to offer them a free lunch that will cost you $5 each. The instructor for the day is coming at a bargain but it will cost you $250 for the day. So your revenue per participant is what you are charging them, $50. And the expenses per participant are the book and the lunch you are buying for each person, and that's $25 per participant. 50 minus 25 means that each participant's contribution, as it were, is $25. Your fixed costs in this case is just the instructor at $250. You take the fixed costs of $250 divided by the contribution per participant of $25, and the answer is your break-even point, 10. You need at least 10 people enrolled in order to break even. So you are not losing money, but not building any surplus. If it's easier, you might want to look at it on this table. $50 in revenue, variable costs leading to a contribution of 25, and the fixed costs and the break-even point. It's necessary to know all your costs first, however. So think about what I would call hidden costs of this service, this job searching program. Are you copying materials? Did you advertise? Is there travel? Are you opening your building for a day and you have to pay extra utilities? Are you renting space, etc.? And what about the program's indirect costs? Do you want this program to help support indirect costs? And think about adding the price per person if you want to create a surplus, a profit. Now you want to think about pricing strategies, which is answering the question, what was your goal in offering this service in the first place? And that goes back to the dual questions we looked at in week 1 of financial and mission and how you balance both of these at all times. Do you want to provide a service for people who would otherwise have no access to it? Or are you offering this program to raise money to support other services? When you are offering a free program, you are doing so to maximize the social good. When you're offering a fee-based program, you may want to be using it to maximize your profit, create surplus for your free programs. Or you could offer what's called differential pricing, which is a sliding scale, enabling people of low income and higher income to access this course. Or you may want to look at congestion pricing, which charges different prices for a program depending on the time of day or time of year, basically depending on the demand for the program. Or you could look at what's called package pricing, and this is for organizations that offer multiple services for a fee, and people can choose to pick which services they want that meet their needs and interests and pay for those together as a discount. Please be sure to do your readings on this subject in this week's readings. It's an excellent summary of pricing options. There remains a question of, can a nonprofit have a profit? It seems like an absurd question if it's called a nonprofit. But of course nonprofits earn profits, and it's easier if we call this profit a surplus. So a profit, a surplus, is very simply when your total revenues are greater than your total expenses. But there's a hard belief that many of us carry that every dollar of surplus, every dollar of profit we generate means one less dollar is going into badly needed services. But that's absolutely not true, because a surplus is necessary if you're going to ensure that your programs are stable and if you ever want to consider growing the nonprofit. Stability means that you are building a cash reserves account. In essence, a savings account that exists so that you have cash on hand during times of low deficit cash flow. And we will be calculating cash flow accounts next week, but there may well be times, there almost always are, where the cash coming in is less at a particular point in time than the expenses going out. And the biggest concern is always about making payroll, because it's the most immediate need. It will show up every week or 2 weeks. It's the largest single expense that most nonprofits have, and not making payroll has the largest, most immediate legal and social bad ramifications. There's a very nice formula for you to calculate how much you should have in reserves to ensure that there is 1 or more weeks of payroll set aside. You take your annual personnel costs, everything, not just salary, and you divide it by your annual expenses and multiply that by what percentage of payroll periods you wish to be saving for. Each week is obviously 1/52nd and looked at as 2% of payroll. If you have a payroll period of every 2 weeks, it would be 4% of payroll you want to be sure to have set aside. Ideally, it would be even more than 2 weeks. Like everything in financial management, it's all about transparency. And if you are totally transparent about the surplus, the profit your organization is generating, if you're able to publicize, make clear, and share what this surplus is for, that it is to secure stability, you are building reserves, or you're planning for a new improved capacity. This is key to not only public acceptance, but even public enthusiasm for supporting developing this surplus. Future-looking donations, I want to talk just a minute about the donor-advised fund. Many of you have already heard about this, but in fact, it's the newest and fastest growing vehicle about charitable contributions. The way it works is a wealthy individual, the donor, sets up a fund with a financial manager. That's usually a bank, an investment firm. Fidelity Investments is the largest manager of donor-advised funds, way ahead of everyone else. And that money is now permanently set aside. The donor gets the total tax benefit up front at that point. And the donor or the financial manager can decide when and how to distribute the money, and meanwhile the financial manager is getting a fee for this work. The advantages to the donor are that he or she gets an immediate tax break and somebody else, a professional, is managing the money. However, critics are increasingly concerned that the true beneficiaries of donor-advised funds are the donors and the people who manage the money, not the charities. The donors get an immediate upfront tax benefit. And we have to realize that when there's a large tax benefit, it means that the federal treasury is not getting some revenue that is needed for government services. But the donors and the financial managers have no obligation to ensure that they distribute this money to charities in a timely fashion. In fact, there's no requirement that donor-advised funds even have to be distributed, so that the money can sit there earning interest, paying fees for the financial managers, and providing the tax break for the donors, and the money is just sitting there. So it remains a hot issue that will probably be going under further revisions in time to come.